The aim of this process really isn't perfection. No business is going to have a completely clean DD process. That doesn't happen. But you've got to have the paper trail. You've got to be able to explain the position clearly and show if there are gaps, you've got a credible plan for that. That's the key. If that is all set up nicely, cleanly, that will give an investor a much bigger step of confidence. AI products are different because they're less predictable. The outputs vary, the reasoning may be hard to explain, the risks are harder to spot. I think in any business, you've got to be flexible. And as I say, that ability to pivot is key.
Technology and law often run in parallel during an investment decision, yet rarely fully meet at the same table. On one side, technical experts focus on understanding the product, evaluating its scalability, security, and the architecture's ability to withstand real-world pressure. On the other side, legal and commercial advisors analyze ownership, contracts, compliance, and potential hidden liabilities that could surface months after, years later. But the thing is, both should always be in the same room. I'm Lucas, and this is the Dev is in the Details podcast about technology leadership and real-world execution. My guest today is Simon Weinberg, commercial and technology lawyer. Simon supports tech companies at various stages of growth, advising them on strategy, contracts, intellectual property, and data protection. In this episode, we will explore due diligence scenarios where things look solid on the surface, but start to unravel when examined more closely. We'll discuss why combining technical and legal due diligence is no longer optional in today's rapidly evolving AI-driven product landscape. Simon, welcome to the show.
Good to be here. Thanks for having me, Lucas.
Absolutely. It's, I've been really looking forward to this conversation. There's so many things that are close to my heart, in this episode. So
Sure.
Let's start with, due diligence. When people hear it, usually they think about the financial review, P&L review, financial statements, and so on. Why, in your mind, legal and technical risks now could be considered equally important when you deal with the modern deals?
Sure. Looking back at finance, finance tells you the numbers, right? And you can see the numbers may work, but they don't tell you the story of the business. They don't tell you whether the business can actually deliver long term on the story behind the numbers that are in the financial diligence. Value, the value of a business dictates into the numbers, right? That's what's reflected in the numbers. But that value sits in things like code, data, IP, contracts, the operating model of the business. So the legal and the technical risks, I suppose, go straight in to the value and scalability of the business, straight into those financial numbers. So diligence should never have been just about spotting liabilities on a balance sheet. Albeit, I think historically, maybe that's where things used to lie. That's where the focus used to be. Today, it's much more about testing that the commercial story is true in practice and is scalable. And that should always have been at the forefront of the mind of anyone doing diligence on a business 20, 30, 40, 50 years ago. But the way that those businesses were made up, what their business was, meant that the finance was maybe more relied on than anything else.
And do you think there is a risk involved in treating, legal and technical due diligence as two separate things, or maybe one of them as an afterthought to another?
Yes, there's a risk, and there's a risk in treating finance separately to them as well, actually. When you're doing due diligence, you have to look at things in the round, right? There's a holistic approach that you need to take to be able to fully understand the business. If you're going to treat each track separately, inevitably you can have blind spots, right? And someone who's doing the technical due diligence may understand the products, but not have a clue whether it owns the product properly, whether it can use the data behind the product in the right way. A legal reviewer who's only looking at contracts, it might spot a contractual issue, but may completely miss something within the business that is missing. A dependency that isn't fully set up, an integration that is key but not reflected properly in the contracts, a security gap, right? Those things are all key parts of technical due diligence, but you might miss them if you're only doing legal. Overlap is where the big issue sits, right? The core value of any business, like we said, the IP, the data, the AI training data, and where that sits, open source, cloud hosting, third-party APIs, security, outsourcing, those have a lot of legal points with the contracts and how the contracts are set up and the IP ownership and the data rights. But technically that fits in with how the business is structured. And from a finance perspective, it impacts valuation. It impacts the numbers that the business may or may not be meeting. So you have to look at it holistically, and that's the only way that you'll really understand the business as one thing rather than as separate tracks.
And what kind of specialist or individual profile as an employee or an auditor, right? That when you perform due diligence, are you looking for among your team to fill in those completely different roles, actually, right? Between technical and how do you deal with that?
It's a team effort. It's got to be a team effort. When you're sitting down and doing a due diligence project, I mean, as an example, we're a bunch of lawyers, right? Some of us are more business and technically adept than others, but we like to think of ourselves as fairly switched on. But when we're performing due diligence with one of our clients, we need them to be transparent and open with us and explain how the business operates. And once we are working as a team, then we can properly assess the technical and legal together. Factor in the finance side. We need the finance people to also meet in that, so that everyone has the right context before they answer the relevant questions in let's say a due diligence questionnaire, or start dealing with potential investor and what they're asking for. So it's got to be that team effort, but people have to have a business awareness to really get to it. So when we're sitting down and doing due diligence, our lawyers have to understand the business and really get to grips with, well, what's risk here? What are people looking for? What's the investor investing in? Where's the value?
Of course.
It's big picture, and everyone needs to have that. So the technical people similarly need to sit down and really understand, well, okay, I understand that we've got the infrastructure behind the business, but what are the legal risks to that? I need them not to be blind to that and to really open their eyes and say, okay, well, okay, I get it. I understand that there is a legal risk here, and I can't just push it to one side or ignore it.
What would be the most common cases? Like if you could anonymously speak to it, like what kind of risks do you see most frequently when performing DD?
I'll come at this from the perspective of how I mostly work. If you ask some of the more corporate focused lawyers, they may talk about shareholders agreements and failures in corporate governance and stuff like that. From my perspective, you're talking about a lack of certainty around IP ownership, especially in the tech world. External contractors coming in and doing work, but without a contract or on a contract that doesn't assign IP. Use of open source, but without fully understanding the implications of use of open source in terms of action and distribution.
Licensing issues?
Licensing issues. If you're using third-party products, data and data mapping, not knowing where the data is coming from that you use within the business. A failure to properly contract with the people who are delivering for the business. So that might be employees or contractors, but on contracts that don't do the business any favors. From my perspective, those are kind of the core risks that come together. But it all comes back to product. It all comes back to the commercial reality of the business, right? If we're talking about a tech business that's looking for investment, that's where the value is. And if you start answering questions in a due diligence process that doesn't give much comfort to an investor, that value is just going to get chipped away constantly, because the investor will just see risk.
So that's actually, let me follow up on this a bit. I'm very curious. So let's say we have a business which, evaluates itself at 10 million or 12 million, whatever. And then you start the DD process. And as you said, the value is being chipped away. Do you frequently see that it's more of a binary decision by investors saying, yes, we're going to invest, no, we're not going to invest because of the DD findings? Or is it more like, look, we're going to invest, but let's agree that it's just 6 million evaluation at this stage because of the findings? What's the most common case?
It's definitely not binary. I mean, it is. it's very case specific as to, it depends on the investor, the business, what the issues are that come up. I would say that walking away altogether is kind of a last resort, or at least I hope it is. An investor may just want a lot more shares or a lot more punch within the business, a lot more control. If the valuation isn't quite what they want, they may want to invest less. There are a whole bunch of scenarios that could be the outcome of those risks coming up, but all of them really come down to a business owner not necessarily getting what they are expecting to get, right? They're not going to get the money, or they're going to lose more control.
Right.
Or as you say, they may not get the investment at all. Or they may get everything that they want from a financial perspective, but the conditions of the deal, the onerous nature of the contracts may be far, far more than they were initially willing to accept.
That's that's really interesting. And do you feel like investors usually seek to optimize the conversion of money to shares to get more equity, or is it more like about the control, having a board seat? Like, when I ask this, I mean between the original term sheet and the actual, final contract.
Like I said, it really does depend. I mean, some investors don't want a place on the board, right? It's not of interest to them. Some investors don't necessarily want control at all. Not something that they're too worried about. It really does depend on the nature, like I said, of the investors, the business, and the issues that come up. And it could be, for example, that there are serious issues in the business from a security perspective, and they don't want control, but as a condition of the deal, it's like they may have a security person that they want to bring into the business. Say it's a condition, they come in for 2 years and solve all these problems. It really does depend on a whole bunch of things.
At what stage should founders and the leadership team start their preparation towards the diligence process? Like if you have a fresh business, in its development, what are your thoughts on that?
Okay, so again, I'm going to answer this in two ways. Number one, as a lawyer, straight away. So the first thing they do when they start the business is they'll be thinking about the due diligence. It's not the reality. I get that, right? You start a business, you're focusing on product, you're focusing on getting a viable product, getting some revenue. If you're bootstrapping, that revenue is so key, right? Because you want to start paying yourself. So
Totally.
that ultimately that there is a balance there. But yes, ideal world, day one, right? You should really be building diligence hygiene, I suppose, into your ordinary operations before fundraising starts, ideally before sales start. And you've got the sales pressure, because as soon as the sales pressure starts, that's when you start getting distracted into other things. If you're going to wait until a deal is live, then usually it's just too late. If there's a foundational issue, you can't really deal with it when the deal is already live. By that point, it's too late. So things like IP ownership, data mapping, security issues, if it's such a core issue, it's an exceptional problem that has come up. If the deal is live, it's a massive concern for the deal. The aim of this process really isn't perfection. No business is going to have a completely clean DD process that leaves everyone very happy and it's, slam dunk. That doesn't happen. But you've got to have the paper trail. You've got to be able to explain the position clearly and show that if there are gaps, you've got a credible plan for them, right? That's the key. And something that we often do is pre-due diligence projects. So a client will come to us and say, we're thinking in the next couple of years of investment sale, whatever it is. And before the transaction is live, before there's a term sheet, before there's even a list of investors, we're basically building a data room that you can open to investors or buyers when the time comes. Like I said, it doesn't stop further questions being asked at the time, but it means that the business has covered the standard diligence areas, and they've got kind of an open book approach to the business. That gives them control in the process, control of the narrative, and shows investors also that you're really proactive about this. You're on it. Rather than reacting to problems as and when they come up. I've got into my business and I've not sold everything, but here's a business that we care. We've got a paper trail that shows certainty and stability and a plan for the future. And that's investable. Chaos is not investable.
Sure. Makes perfect sense. And before, when you do this pre BD, right, to prepare
Yeah.
your that business for an actual investor to have a look at it, do you think everything is fixable, or what kind of things are not fixable given the under the assumption of infinite amount of time before we start our fundraising?
Good question. I would say that most things are fixable. You may have a bunch of different like warning signs and things like that, but generally, I would say that things are fixable pre-deal. Things that may not be fixable are things that would undermine the value of the business altogether. So it might be you've used a bunch of contractors to develop code for a product. You don't own the IP, and those developers are not interested in assigning it to you. You've not managed to sort it out. And so when you go to
Oh wow.
market for investment, you can't really give any commitments around IP ownership. And those developers effectively hold you to ransom, right?
Yeah. Does it still happen? I mean, I thought these kind of, pretty much any contract now, and I'm speaking about my experience in EU and US
Yeah, yeah.
mainly. I know you operate across multiple markets, but just out of curiosity, because there's also, AI tools nowadays, right, that evaluate
Yeah.
contracts for both sides. There is also some sort of lawyer always involved. Do you think this is a common mistake still, that people would have
Yeah.
misassigned IP rights?
Yeah. I wouldn't say it's as common as it used to be because I think people are, I say this, uh, hopefully more sophisticated than they used to be, but it's definitely still a problem. And I speak to real startup bootstrap businesses regularly. It's like, okay, well, who owns the code? Oh, I used a contractor for it. Who were they? Oh, I used this like
Hmm.
website platform and they just like marketplace and I found someone and they did the work for me. Have you got a contract? I don't know. Never really thought about it. Right.
Right.
Um,
Right.
so it does still happen. Um, Probably not as much or as extensively as it used to, but it does still happen. You may also have just really, really poor technical and security infrastructure that can,
Mhm.
you know, the amount of money that might cost to resolve means that by the time you've got to market, you've got nothing left. So again, also over reliance on third parties. So if you outsource a lot of stuff, and we may come onto this later in terms of AI products that kind of just a layer on top of others. It's the traditional, to be
Right.
honest, reseller model. It's the traditional reseller model. If all you're doing is selling other people's products, but nothing of your own, then uh, there can be a lot of risk in those reseller contracts where you don't really have the right to build the value of your own business.
Mhm.
So those are things that may undermine everything from the start. But generally, things are messy but fixable, I would say. Most things are, because as long as you know about them and you can wrap it up, then with time and budget, then it is generally workable. But as I say, IP ownership, serious privacy or security issues. If you built everything on architecture or a tech stack that can't scale, right? These are things that make it very difficult. If you go into a DD process with those, I would suggest that the investor's probably not going to go very far with the deal.
I'm curious because all of these, right? The IP rights,
Mm.
scalability, maybe even the right tech stack for the job, all of these are, let's say, well known, right? And kind of
Mm.
common or occurred, maybe uncommon, but they occurred over the years.
Yeah,
What are the new ones? What are the new kind of issues like AI slop or you tell me what else is out there which is now emerging as a red flag?
it's definitely AI. I think data protection is still a bit of a red flag. I think people still struggle with that. Um, and one of the things that I often see, it's like when you're starting a business and you're in like mud startup territory, you're literally going from a standing start and then jumping onto a treadmill. You've got no time or anything to look around and think about the big picture of what may come in the future. So it may be obvious to you as a tech person that, you know what, a product like that needs a certain architecture behind it. You would use this product, and this product out. You build it, and then when you've got it, you would use. If you've just jumped on the treadmill and you've got a great idea for a product, but none of the technical background, you're going to be reliant on what you can find out on Google, what friends tell you, who you can find who might want to take some of the shares in the business, and it's going to help you for that. And before you know it, it's run away with you. So I think those old things are still an issue for high growth businesses where people are maybe on their first or second business, right? Sophisticated, regular founders have knocked those issues on the head because there's someone that they know who can deal with that for them, advising them in the right way. They've experienced it before. So I think the naivety still brings those issues. In terms of what issues are now there, like I said, I think data protection is still an issue because people don't really think how all-encompassing data protection is and how much of an issue it can be. AI is the obvious one to point to. I think it's also a bit misleading, AI, in that a lot of AI products are SaaS products
Exactly.
at their core.
Yeah.
So when you're doing due diligence, someone says, "Oh, we're using AI products," there may be a tendency to kind of throw your arms in the air and panic, but that's not necessarily the case. A lot of the questions that you're asking about an AI product are the same questions we've been asking for 15 years about SaaS. But there are obviously things, it's the outputs that are more complicated in the way that they're used. So AI products are different because they're less predictable, right? The outputs vary, the reasoning may be hard to explain, the risks are harder to spot from the outset, which makes them different from traditional SaaS, which is more predictable. They have a specific outcome that they are intended to achieve. AI doesn't do that. By definition, they're to give you an unpredictable outcome. And so when you're doing technical diligence against AI, you've really got to understand the model, the data, the testing, monitoring, accuracy, risk of hallucination, all of those things. The legal diligence, though, like I said, is probably a lot of the same questions, just from a different angle. Data rights, privacy, who owns the IP on the inputs and the outputs? What's the regulator exposure? How is it covered in customer contracts? So when you, from an AI perspective, legally, we're asking a lot of the same questions because the technical reality is what it is with AI to a large extent. But the technical side of the DD has to understand that. And I suppose that's the hardest jump at the moment. And I'm finding it not just in kind of DD processes, but where suppliers are engaging with customers to provide services that are underpinned by AI. The customers just don't understand how the AI works. And they have a list of demands of what they want from an AI product. And they're just remarkably unrealistic, right? And I think that's true across the market. People generally don't understand how an AI product works. At big businesses, right? We've got some clients who have customers who are listed companies in the UK, and they'll get a markup back of a customer contract in AI, and we'll read it and think they don't understand AI. It's obvious they don't understand AI. So I think that is the issue with diligence on AI. It's the lack of technical understanding of the product. And often when a lawyer is doing diligence on AI products, they're asking probably the wrong kind of questions, right? From that perspective, they need to understand the product first and then start asking questions, probably of their clients, the investor, and saying, what are you worried about from an AI perspective? You can't just go by the book with it.
I agree. I also feel like partially investors and investment market is responsible for this because the buzz about the AI kind of forces young founders to give their startup this AI sticker, right? In the front seat to say we're AI first, AI enabled, all of that, marketing. But when it comes to actual AI implementation, if we were to qualify actually custom AI build versus AI integrated, how frequently do you see that something which advertises as an AI for sake of investment, right? For sake of attracting investors, is actually just a plugin or API integration with one of the vendors out there?
Sure. Look, it's a lot. In the old days, it used to be we're an AI product. This is like 5 years ago. We're an AI product, and it's not AI. It's just some sort of automation tool. So it's not necessarily AI. What we're seeing today is a real mixture. I think that the number of true AI businesses out there, rather than integrating with other, is probably quite small. Maybe I'm being cynical with that, but most of them are integrations. Sweeping statement, I know. But I think the core players out there, we know the core players.
Yeah, absolutely. And it's I mean, the IP that I see is usually around even using those third party and well established models or companies that are out there, big names, but in a specific way. And do you consider that an IP? Like, for example, if someone builds a chain of models that operate together, chain of agents that operate together to perform, as you said, automation, 100% accurate, and eliminate the need for human supervision. How do you feel about that? Is that unique enough? Is that AI as an example?
It's definitely leveraging AI, isn't it? It's all about marketing. I'm not the best marketing person to ask the question of, but I think if I was an investor, I would be saying to these businesses, what is the AI model on which your product is based? And generally, it would be third party. Oh yeah, we've got a bunch of agents, and that's fine. And there may be a lot of value in what people have built around those agents, and often there is. And they will describe themselves as an AI business, but we're just talking about semantics, I think. I would prefer people to look at products and value and the problem that they're trying to get those products to solve, rather than a semantic tag as to whether something is or isn't AI.
I generally agree. There's one thing that always gets me curious, which is what kind of unique moat the business has. And frequently with the modern AI models, with everyone can put their hands on, it's a commodity at this stage, I would say. It's a matter of data, right? So if someone has a very unique data they accumulated over years, and now they can apply the same model that anyone else can, but they have no data, that's potentially the upper hand. Do you feel like in your work, you actually end up educating your investors and educating your founders because of what you just said? Because, they need to be a bit biased, right? I mean, founders especially, they need to really, be in the belief that this is the next greatest thing after, sliced bread. So how frequently do you actually end up re-educating them or changing their point of view? To a certain extent, founders need to be delusional, right? to move forward fast.
I was going to say, if a founder comes to me and they don't think their business is the best thing since sliced bread, then I'm worried, because how are they ever going to pitch it?
Yeah.
And for me, I mean, it's difficult. Sometimes I do have businesses that we talk to about doing an investment round, and kind of in my gut, I kind of know that what they're doing doesn't really have a lot of value, or they're really going to struggle to raise.
Got it.
It doesn't happen regularly, but maybe that's just the cynicism in me. But obviously, we do whatever we can for them. But the delusional nature of a founder is that, right? You want them to come and say, "I'm going to do everything to make this work," because if they're not willing to do that, then no one's going to invest in them. And truth is, I'm a lawyer. I'm not the tech investor. I'm not the person to sit there and say, "I'm not going to invest in you." So, is there a re-education? Maybe just in terms of big picture. So if we're working with to be honest, either founders or investors, we may really push them to say, well, what is the big picture, and what are you looking to achieve? Where are you trying to get this product to? Is the raise that you're looking to bring in too high, too low? Are you properly assessing the market? So we'll have all those conversations. And it's interesting, actually, because sometimes we do come across a business that is completely lowballing themselves. Just as an example, maybe a couple of years ago, we spoke to a business that says, we're going to go out and try and raise £500,000 from, and there's quite a few investors and some quite sophisticated investors. And we really challenged them and said, well, is that going to be enough? Are you being ambitious enough with that raise? Because if you're looking for a runway of 3-4 years, let's say, obviously with top-up rounds along the way, but this isn't going to get you near that runway. Why not go bigger? And they did go bigger, and they got it. So sometimes it's not education, re-education in terms of the product, but sometimes founders,
business reality awareness.
Yeah, they just need to take a step back because they're so involved in the products and thinking about the short term. I just need to get it to this point. Yeah. Sometimes they sometimes need a bit of counselling on that.
And do you have cases where someone is pitching a massive SaaS business and multiple rounds, and at the end, for example, they take just seed round or just round a Series A, and then they never again need money because it's such a skyrocketing business, and maybe they don't IPO, and investors like like the promise is that they can sell secondaries in the second or third round, right? Series, and then maybe even in IPO or M&A. But what if it doesn't happen? How do you structure something like this? Is this something that comes back?
I would love to have more clients that didn't need further investment. I think you come across in the press various businesses that just literally skyrocket. And you've heard about it in the past 2 or 3 years that there's some pure AI businesses that have built an incredible amount of value and they've been sold for tens of millions within a few months of actually starting. There's one that I heard about that I think was just one guy. And he was the business. And he built such value in such a short period of time. And so it can happen. I would say it's rare. Most businesses will be looking for the next round and the next round, not just for themselves, but also for the investors. I think the investors come in and they want a return. Obviously, they want to see the businesses succeed, but that is so that they can get their return. So there's always kind of an in and out, usually, generally. And there are some businesses that get to IPO and then pull out of being publicly traded because they want a different way of ownership or a different strategy for growth. But I think at the start, when you're looking at a business that's thinking about seed, they've got no idea what their trajectory is going to be generally. It could be anything. It's quite hard to plan when you're a seed round for IPO and whether or not you want to go with it.
Yeah.
It's such a bumpy road, especially, I suppose, at the moment in the current market. You've got some businesses, like I said, that are absolutely skyrocketing. There are plenty of others that have got great products that aren't really getting the traction because it's a difficult market. Certainly in the UK, it's probably quite a hard market at the moment. So I don't know if that answers your question. Some musings on life.
Partially, yes. But you see, I always find it fascinating that investors are looking for the promise of another unicorn, right? But as you said, at Series A, usually at seed round, people, they're gonna obviously promise the moon, right? Because it's just a promise, and
correct.
Along the way, you may have a pivot or two, or you may even not have a product market fit. I mean, one would think that at Series A you should already have a product market fit, but still things change, right? Like you realize, there's adjacent market which is much bigger, and we need to go there instead, or something. What happens when investors are disappointed?
Yeah, the ability to pivot, right?
Exactly. Like, how does the, let's say, seed round investors' disappointment impact Series A?
More?
Well, I mean, imagine, I don't know, let's say we're starting a bakery, right? And we promise amazing breads and whatnot. And then we realize that actually pastries are where we should go to. And the initial set of investors are unhappy. A couple of years ago, I had a case where I had a business which was supposed to be technology business, but we mostly got marketing and advertising based people to back this up as angels, and they had a significant impact on how to steer the business into the direction of being more brick and mortar than a scalable SaaS platform, which obviously impacted our next Series A and even what was the evaluation at the exit of that company when it got taken over. So that's my experience. I want to hear like examples from you where maybe someone started with a promise, look, we're gonna build 100 mil company over the next 5 years, and actually they ended up building 10 billion or whatever, sky's the limit company.
Yeah, I think in any business you've got to be flexible. And as I say, that ability to pivot is key. I think it's pretty rare that a business will have one idea at bootstrap stage, and that idea is still the core function of the business as they go through Series A, B, whatever, and are sitting at the top of the market. I think that their product and their product breadth is probably way wider. Once they're a successful business, they can't predict which products they're going to be in from the start.
Right.
That original product may be something that they canned pre-Series A because it wasn't getting enough traction in the market and they pivoted to something completely different. I think that it's what's very difficult for founders is that they can be very tied to the product that they started with, because that's where I suppose the effort and love went into at that starting point. That's what they were delusional about from the start.
Okay.
Sometimes it can be difficult to then say, you know what, I'm going to come that and go down a completely different road. It can also be hard to do that when the investors have invested in a particular product. And then you say to them, actually, I know you've invested in that, but I'm going to do something else now.
Mm-hmm.
It can be walking a tightrope sometimes, depending on your relationship with the investors. Sometimes investors might say, yeah, I agree with you completely. From a cash flow perspective, we're struggling at the moment. We need more revenue. What you've suggested looks like it's going to get more traction in the market. For sure, we should go down that road. The road to success is unpredictable. Everyone says business is hard work. They don't say that for no reason. It is hard work, and part of that hard work is being flexible in how you approach it. It's the old mantra of you need to make enough mistakes before you're successful.
Of course.
Success doesn't come automatically. So everyone within the business, the business owners, the investors, C-suites need to be comfortable enough making those mistakes that eventually pivot them to something that works really well. And that then brings success. Sometimes you haven't got the time to do that because you haven't got the runway and you can't then get the follow-on investment.
Yeah.
That for me is one of the key things, that when you're looking for an investor, you're trying to get the trust in your decision making, not just the product.
Totally. And this is sort of reputation game, right? For the founders.
Yeah.
Because even if they pivot, but they actually deliver on a promise, of financial outcome or multiplication of the business, I think at the end, everyone is going to be happy. And that's very well understood. How about the reputation on the other side? Do you feel like different investment groups, companies, or types of investments have different reputations for founders to consider as well?
Yeah, for sure. For sure. I mean, the cultural fit of an investor to a founder is key. If that fit is not right, you see real destructive relationships out there that mean it's very hard to grow the business, scale the business, pivot the business when necessary. So as much as it's one of the things I often talk to founders about, that you've got to do your own due diligence on the investors to understand what market they're in, what value they can add. If they want to be on the board, do they have experience in your market? Do they know what's going on? Are they going to be able to add value in that board seat? And you see it go both ways. You see some founders and investors have a great relationship, and there's real comfort there. If they're a silent founder, they're doing exactly what they want. If they're a silent investor, they're doing exactly what the founders want. But equally, if they're very involved, they're doing what the founders want. At the same time, you can have investors that want to be involved in everything and destroy the momentum of the business. Or if the investor's got an opinion, the founder won't listen. That can also be destructive, because the investor opinion, if they do have experience in your market, could be gold, and you're not listening to it. So that relationship is fundamental to anything. And certainly a bootstrap stage, when you're looking, okay, I need seed now. Sometimes the panic to get that initial investment in is so high that people are willing to give away anything to get that investor involved. Control sometimes, but just involvement and say and decision making over the business, and that can be really dangerous.
Fully with you on this. And while through due diligence process, do you share your observations about the investor founder fit or not?
It's not something that is kind of top of our list necessarily. It might come across because of the legal aspects of it, where the investor is pushing for a bunch of stuff in the investment agreement that is just not appropriate, feels uncomfortable, feels onerous, is over the top for the value that they're getting, etc., etc. So it may come across in that. Certainly a discussion we'd have at the beginning with any business owner that's looking to get investment, to say, how's the rapport? Have you looked at the rapport? Have you looked beyond the money? It's not necessarily a legal point, but as lawyers, we don't want to sit there and watch this fall apart. So it is something that we'll raise, and if we're seeing something obvious along the way, that's fine. But often the investors and the founders will be sat there chatting in the background whilst the lawyers are having arguments about the documents. So we don't necessarily see the positive or negative relationship between them. We'll ask and we'll push, and we'll try to make sure that the founder has done their diligence on it. But it doesn't always happen. It's not what they want from us.
Interesting.
It's not necessarily what they want from us. We like to pride ourselves on being a business advisor as well as lawyers, right? That's obviously within the realms of legal advice. And what we come across generally is that as long as it's got a legal link of some way, that strategic approach of talking to clients about that bigger picture and strategy and third-party involvement and those kind of things, which are borderline not legal, it's important. But sometimes clients just don't want it and they say that's not what you're here for. And that's fine. If they feel like they've got an advisor set around them already that ticks those boxes and they just want us on documents, that's fine. But we've got quite a lot of experience, I suppose, over the years of working on all of these deals and working across markets. And sometimes we've got something useful to say.
Super cool. And what else is in your report? Like, what's the narrative? It's like carrying on the points you just made. So it's more of a, look, we see this and that, and we flag it yellow or red, and the investor makes up their mind, or the founder makes up their mind, or is it more like this is my recommendation? Like, what kind of language and what kind of structure do you have?
It really depends on what the client wants. Sometimes they'll just say we want a traffic light report, green, yellow, red, high level, very straightforward. Others want a lot of detail and want a recommendation as to next steps, and they'll want us to act on that recommendation before the deal is done to make sure that things are resolved. So again, don't want to sound too lawyerish about it, but it really does depend on the circumstances. And we can go from light touch to heavy touch to really quite detailed, depending on, I suppose, the client and the risk that is involved.
Even in technology? Architectural choices?
I think that there's probably a line that we draw somewhere and say that they need to get their own tech team to do that assessment. Questions around architecture, I can say, well, who are your third-party providers? But what the InfoSec outcomes of that are, have they got SOC 2? Okay, well, there's a bunch of questions on it. Are you going to answer them?
Yeah.
It's not really for me to answer. It's something that the InfoSec team and the tech team within the business need to look at themselves.
Yeah, of course.
So we may help guide the approach to answering questions on those kind of things, but we do need that guidance from the business. We need them to lead it, really.
You mentioned SOC2, which is a very American thing, right? Or is it in UK, popular in UK as well?
Increasingly, it's popular in the UK. I mean, the UK is mostly ISO, but some people have both. I mean, it's just a bit of whatever works.
Makes sense. But how do you feel your work and your due diligence process changes based on the market and specific geography or a legal system?
Good question. I would say it depends. I mean, most of the work that we do is based around the UK market, and there might be international investments into UK businesses, or UK investment into international businesses, but there's always kind of that UK aspect.
Okay.
And when we're dealing cross-border in some way, generally the difference is around investor approach more than jurisdictional approach. Now, obviously things are different in the US compared to the UK.
Sure.
Things definitely are. But when we're sitting down and talking about the approach to due diligence that people want to take when they're our client, it will tend to build it around what the investor wants. And we'll give them a range of different options, like I said, about the level of detail and what's high risk. And do you want us to really delve down into this particular point, but not that one? So it really does depend more on the investor, I would say, rather than the jurisdiction. We try and take the same menu wherever we are. But the approach for sure is different in different countries. And sometimes when we're dealing with lawyers in the US, the approach is different, as you would expect.
I wonder if, for example, I don't know, just making this up, but as an example, right? You have a UK-based business and they want to invest in France or somewhere else in EU and the European Union. I mean, for all its greatness, it has actually, dozens of separate, unique legal systems and jurisdictions, actually, despite, some degree of federalization. So, how frequently would you, for example, rely on a local partner or a counterpart for yourself in German or French market to understand and act as a translator for the definitions that you know as a lawyer
Yeah,
and
yeah, yeah,
make
yeah,
sure that they logically mean what they mean, for both parties.
yeah, yeah. For cross-border stuff, most times, again, it will depend on the client. Sometimes the client will say, "We just want you to do it. We're not worried about getting someone in Germany or France to look at it." But generally, certainly for investment type work, we'll co-counsel it, and there'll be people in local jurisdictions that are helping us. And often we'll play that role as well. I mean, as we've spoken about, we have our main offices in Tel Aviv, and obviously there's a huge amount of investment activity going cross border from Tel Aviv to the UK to the US, wherever it is.
Sure.
The Israeli market is obviously very niche in a lot of ways. The culture is very particular, and often we will help international lawyers kind of plug into the Israeli market so that to reduce friction, because it can be quite high friction at times, and just to try and, as you say, translate in the middle to make sure things are still running smoothly. So we do that quite regularly as well for the Israeli market. It's when you're dealing with cross-border transactions, it's just part and parcel of what goes on. And yeah, we have lawyers across jurisdictions that we work with regularly on those kind of things.
Fantastic. Okay, cool. All right. So for closing, I have a question for you and as an advice to our listeners, potential, founders and investors.
Sure.
What would be the top three things, before due diligence starts that they should prioritize? Assuming that, there's a fresh business, fresh investor,
Yeah.
or just at the table, we have the term sheet, right? Because something was already agreed upon, and now the DD starts.
Yeah. What should we sort out first?
Exactly.
Yeah. So it's going to run through some of the themes that we've already spoken about, is the truth. But my perspective, IP ownership, prove ownership and control of the core technology stack, right? Make sure your IP assignments are clean, your founder agreements are clean, you've got transparent contractor contracts, you've recorded open source that you're using and third-party licenses that you're using. You've got all of those things in place. Second is data and data mapping, as we've spoken about. What data is collected? Where does it go? Who processes it? What lawful basis apply, right? Do you have the right to do this with the data? Do you use AI? Does that change the risk profile at all? So that would be the second thing to really dig down into. And the third is probably operational reality, product roadmap, architecture and documentation, security. What are your key contracts in terms of hosting, AWS, and that kind of stuff? So it's kind of that operational reality piece to make sure that you know what the investor is actually investing in. What is the value? What is the product value that you're looking to scale? But I would say, as a wraparound to that, basic corporate hygiene as well, that sits around the lot of it. Because to be honest, an investor will also start asking questions around shareholder records and constitutional documents and option schemes and stuff like that, cap tables. And if that is a mess, then that will also be off-putting. It's not as exciting as IP or data or operational reality or whatever it is. But that's kind of the wraparound of everything. If that is all set up nicely and cleanly, that will give an investor a much bigger step of confidence when looking at all the other stuff.
That's brilliant. Thank you, Simon. But you brought something interesting up, which caught my attention. So when I have a cap table with an existing investors, how frequently that is an issue for the new investor? That there is some other investor type or kind or specific person where there is a personal issue between these two folks to not invest in. How frequently does that happen?
I would say quite rarely. I think they're looking at the cap table just to make sure that it's right, and what the percentages are and things like that. I think it's more from an accuracy perspective rather than a personal perspective. Thankfully we haven't come across that kind of thing so often. Investors sometimes fall out later. Thankfully that doesn't come onto my desk, but early doors just by looking at the cap table doesn't often happen.
All right, thank you for additional insight. All right, Simon, thank you so much for sharing your perspective. It was very insightful and practical.
No, thank you for having me.
Absolutely. And the real risk picture only emerges when both perspectives are combined, as you mentioned, and because many critical challenges sit exactly at the intersection of code, contracts, and commercial reality. So if you're building, scaling, or evaluating technology companies and want to avoid blind spots that can impact valuation or even derail deal success, feel free to reach out to Simon or myself. The details to his company and ourselves will be in the footnotes of this episode. Again, thank you. Thank you to our listeners for listening, and see you next time.